I have decided to tackle two very complex topics at the exact same time here. So I hope that you take this presentation as a starting point for just thinking about these concepts, because these concepts are at like the heart of startups. They're at the heart of every person who raises money for a business's thinking. Like every founder is thinking about these topics. And I will say there is no right way to do a valuation for a startup. There's also no right way to manage a cap table for a startup. There are a lot of right ways to do both of these things, and there's some really wrong ways to do them too. So we're just going to go through some things to get everybody thinking about what are all the factors that determine what my company's worth, and to determine when do I give away equity, and how much equity do I give away, and what do I do with all of these components of my company to make sure I'm geared up for success. Okay, behold, the mighty potato. What is a potato worth? Does anybody know? One potato? This is 5 pounds of potatoes. What do you think one potato is worth? We're going to just do a little valuation exercise here. So, I've done my homework, and I'm going to look like a startup founder with a pitch deck, right? That has lots of like links and things to it, so you can understand that I'm legit. Like I know what I mean when I'm talking about potato valuation. Just like you're going to need to know your stuff before you show up at a venture capital firm or before you apply to RevRoad to know how much of my company should I give away for the investment I'm getting. All right, potato is worth 23 cents. It's 0.47 pounds on average. I know this because of fancy link there that you can see. I did all my research and homework. And costs 49 cents per pound according to Walmart.com. So not a sponsor of this event, by the way. I just threw that in there for free, Walmart. You're welcome. So this potato is worth 23 cents. Like that's not very much, right? And I can tell it's only worth 23 cents. Well, when I take a bite of it, it's not the startup I want to invest in, right? Like right now, this potato is not crushing it. Does anybody want to try one? Any takers? There's nobody brave in this room. We'll even give you one that I did not bite. Anyone? Oh, we got a potato. Mitch back there. Let's see if I kill someone today. Oh, look at that. One-handed. Any other potato? Brave potato eaters? Okay. So you take that bite of potato. I think it's probably not worth 23 cents as a potato. Maybe with some salt. I should have given you some salt, right? Salt and pepper. Okay. So there's some factors that affect the value of this potato, right? What is this potato worth? Does anybody know? Any guesses on what this potato is worth? It's the same potato.
It's $4.50.
Oh, $4.50. This is not like Price is Right. I'm not going to like bring you up on stage. So we got $4. It's a large. Yes. $4.23. Okay. All right. Can I have somebody like hand out some fries? You guys might be more interested in eating those than in the potatoes. But this potato went from 23 cents to $3.59. So we've already grown the value of this startup from nothing to $3.59. That's a 15x return on your potato. Uh-oh. I'm not moving. Do we have a slide mover? It's stuck. Okay, so unless you buy it at the DFW airport, then it's $4.79. So, Scott, you were pretty close. So this is interesting because this is the exact same product in both scenarios, right? There's nothing different about the potatoes that you get at DFW versus the potatoes you get at the McDonald's. As you can see, the source on that one is zip code 84664 in the McDonald's app. So in Springville, that's the price. And over here, it's a 21x return. So we should all just sell potatoes only at the DFW airport. We'll make a lot more money that way. This slide advancer's not working. Can someone push me forward? Thanks. Okay, what about this potato? Does anybody know what this potato is? It's got truffles. It's also got edible gold flakes on top of it. This is sold at Serendipity 3 in New York. Has anyone been there? I've been to Serendipity 3. I spent a lot of money there. It's kind of expensive. You go forward one. Okay, costs $200. It's the same weight as the potato that I just ate for 23 cents, but that potato costs $200. I actually ate there with my daughter and my wife and spent almost $200 and did not order the potatoes. That was just like 2 shakes and almost nothing else. So that's an 870 times return on your potato. This is incredible. Like this is kind of the startup dream, right? We want to take something that starts as an idea, starts as a potato, and turn it into something with value. Now, your brother or sister-in-law with like tons of startup ideas that are different every single time you have a family party, that's a potato. So we want to help you turn that from a potato into something valuable. You go ahead and move forward one more slide. Okay, what about these potatoes? Does anyone know who this is? This is J.R. Simplot. So he started the Simplot company. Simplot is the largest supplier of potato products in the United States, supplies the majority of the McDonald's French fry potatoes. I also audited Simplot back in the day. Very fun audit. So this potato is worth $7.7 billion today. So they sell a lot of McDonald's fries. It's worth a lot. So the J.R. Simplot family and their potato is the 49th wealthiest family in the United States. In 2020, they sold over $6 billion in potatoes. So, as you can see, there's a lot of things that affect the valuation of your company. Is it sold at this airport? Is it sold in this location? Is it sold this way or that way? Does it look amazing to people? And ultimately, is it generating a ton of cash flow? In the long run, we can go from a 23-cent potato to a $7.7 billion multi-generational legacy family business. So this is not an exclusive list of factors that will affect your valuation. It's just some things to think about. So the founder track record. If Elon Musk starts a new company today, is he going to have a hard time finding investors? Is the valuation of his potato immediately going to go from 23 cents to $100 million at founding just because of who he is? Probably more than that, right? And it's not your brother-in-law's potato. It's Elon Musk's potato. Same idea in his hands is worth thousands to millions of times more. So there's traction. This is kind of the obvious factor. How far along are you? How much money does it generate? That's how the Simplot families is generated, is based on their traction. There's ambition. So if you come to a venture firm and you say, hey, I'm opening up a food truck to sell potatoes, and they say, okay, well, how many food trucks are there going to be in 10 years? And you say, like, one. There's going to be one food truck in 10 years, and I'm going to be providing for my family, and it's going to be amazing, and I need $500,000 to get the truck purchased and everything going. What's the answer? No. If you show up with the same food truck idea, and you say, hey, this food truck is going to be at every single parking lot that has food trucks in this country in 10 years, and you are a compelling founder, and you have good economics, and you have all these things going for you, that same food truck idea could be worth a lot of money. It could be worth millions of dollars at the start. I put up there unicorn and camel. You have to have some vision that's bigger. So unicorn is like, let's grow this thing fast. Camel is, let's grow it big but stable. And lifestyle is like, let's just have a good life, you guys. Venture people do not want lifestyle. So just think about that as you're planning your business model. And also in both directions. Not every business model is good for venture. So if you have an idea that is more appropriate as a lifestyle business, there's nothing wrong with that. That is not a slight on that business, but don't try to raise money. It won't work. So, or raise money from your mom, that'll work. Okay, the other thing is investor company fit. So if you have just the right idea for that person who you're talking to, that investor, that idea is worth a ton more because they connect with you. They connect on the concept, on the industry. Stage in the business life cycle. Obviously, if you just are at the potato idea, it's one price. If you've got French fries and a fry cutter, it's another price. If you've bought 50,000 acres of farmland, it's a whole nother price. So that stage really matters. I'm going to talk a lot about this because the number one problem that we see founders have in almost every area of their startup is they act like they're in a stage they're not. They try to raise money as if they're in a stage of their life cycle that they're not at yet, and then they wonder why it's not working. So raising appropriate for your stage is mission critical. What's your industry? What's the market size? How big can this thing get? How good are the economics for this industry? What's the economy like? Same idea right now versus 2 years ago is probably getting a different valuation because there's a lot of uncertainty in the economy. There's a lot of things going on. That doesn't mean it's a bad economy, and it's probably a great, even better time to start a business, but it will affect valuations. What your business model is, if you're trying to build a two-sided marketplace, you come in and talk to anybody, they're gonna say, whew, this is gonna need a big valuation and a lot of money because otherwise it's not getting off the ground. That's almost the hardest business model you could possibly choose. So you're gonna need to be really good at fundraising. You're gonna need to plan on spending a lot of money, and that's gonna mean you're gonna have to convince people the value is big and the potential is huge from what you're doing, and its defensibility is huge. If it's something much more simple, like a SaaS model, then you're not going to have as much of a threshold for getting into that business. It's going to be, you can hire a sales team. You can't do that with a two-sided marketplace. So just that function alone will have a huge effect on what the value of your business is. And geographic location, the DFW airport, is you starting this in San Francisco, in Utah, in Austin, in Oklahoma, the cost of building a business in each of those markets is going to be different, and the valuations are going to be different. So there are a lot of other factors. I'm just trying to help us all understand when we see, oh, this other business was valued at $5 million when it was in its seed stage. That doesn't have anything to do with what the value of your business is. It has something to do with it, but not really. So be careful about comparables. Make sure you're thinking through all of these things. Okay, this is lots of words, so I'm going to talk through this. There are a lot of different methods you can use to value your business. So there's a discounted cash flow method. This is just saying, here's how much money my business is going to generate in the future, and then discounting that back to the present to create a value. There's a market multiple method. This is probably the most common for established, like small lifestyle businesses. You say, hey, the other businesses that have sold in my industry sold for 4 times revenue. So my revenue is $1 million, so my business is worth $4 million, something along those lines. There's the cost to duplicate or replicate. What does it cost to rebuild your business if somebody needs what you've built, but maybe you don't have good economics, but they still need it? It could still be valuable just because you've already built it, and someone else doesn't have to if they buy it from you. Comparable transactions. This could just be, what did a similar company sell for in similar economics? This matters sometimes in terms of market multiple because some companies have weird revenue streams, so you may not be able to use a multiple. The book value method. This would just be selling an entity's assets. What do we own? What's the value of the software? What's the value of the potatoes in inventory? Then there's what's called the Dave Berkus method. That seems kind of weird, the Dave Berkus method. I don't know how Dave got so important that he got to name a whole method, but essentially what this does is for pre-revenue companies, it says, hey, based on all those factors, we're going to give this thing a value of $100,000 to $1 million for each of these buckets of information that we can gather about the business. So 1, does it have a sound idea? 2, does it have a prototype complete? Have they proved they can build something? 3, how good is the management team? 4, do they have strategic relationships? Do they have some leg up in the market? And 5, do they have sales or traction? So that's just kind of a way to look at things. It's not necessarily right or wrong, like I said, but it's one way that some VCs look at things. And then there's what I would call the resource allocation / ROI method. This is sometimes referred to as the venture capital method, but I'm going to call it the Russ Monson method because I'm jealous of Dave Berkus. And one day I'm going to walk into a restaurant somewhere and someone's going to stand up and be like, it's Russ Monson from the Russ Monson valuation method. That's what I'm shooting for here. So what this is balancing, kind of like we talked about with some business that has a bigger scale, like a two-sided marketplace. How much is it going to cost to achieve success? And how much of my cap table can I give away give away and still have a healthy cap table, balanced by the ROI that the investor needs to achieve to make this business work for them. So some form of this is probably the most common venture capital method, depending on your stage. So let's talk about valuations by stage. At the early friends and family stage, your valuation method is love. I think most of you probably have experienced this is true. My first investors were friends and family. They call it the friends, family, and fools round. When you have the potato idea and you're going to tell them about Serendipity 3 and they're going to say nobody in their right mind is going to spend $200 for a plate of potatoes, but I'm still investing. That takes love and or emotion. So the earlier stage you're operating in, the more your pitch is emotionally connected, and the less interesting it is to, say, a venture capitalist who may be more on the math side of things. They don't seem to have like a warm blanket of math. It's kind of like a toxic cloud of math. So what is it worth? However much your mom has, and you, that's how much the investment range is. So we see this all over the place, and this is where we see cap tables get broken very regularly, where somebody will take a small amount of money in and give away 40% of their company and not realize what they've done, because it is kind of worthless then, right? Like, what could you sell your business for at that moment in real life? Nothing. Nobody would buy anything. So how do we come up with a value for something that doesn't exist and we know has no value in terms of a transaction? Oh, also, the pre-money valuation range, I put $0 to $50 billion solely because really it's worth nothing, right? It's worth nothing at the idea stage. But this is where like the most arrogance exists in a founder's life, like before you've been beaten down by the world. So you get my business is gonna be worth $50 billion. I'm gonna raise my first round, $5 million at a $100 million valuation. Hear this all the time. Sometimes it happens, like 1 in a million. And usually it's Elon Musk or somebody like that does it, not everybody else. So in the pre-seed angel round, now you start getting into your business is a little bit bigger. It's not just an idea. It's gone from potato to French fry. Maybe not good French fry, but there's something you can eat without cringing, right? So now the valuation methods are still a little bit emotional, still a little bit judgmental, but a little bit more rigor behind them. So we see something like that resource allocation or the Russ Monson method. Say it with me, the Russ Monson method. Okay, and when I see any of you at a restaurant, you better make my dreams come true. Or the Burkus method. So investments in the pre-seed angel typically range from $100,000 to $1 million, and the valuations can range anywhere from $2 million to $5 million. They can be lower or higher than that in rare cases, but most of what we see is in that range. Now you get to the seed stage. This is starting to get progressively more mathematical, more logical around the valuations. You start to pull in comparables. Some companies maybe start to get offers to be purchased as a replacement cost or something along those lines. And the investment range, and all of this information is actually from the Wilson Sonsini 2022 Private Company Financing Trends Report. So it's pretty well validated information, although it's not market specific. So you'd still have to adjust these ideas by those factors we discussed before. So at the seed stage, typically the investment's 1 to 5 million, 2.3 million is the median, and you're talking about a valuation of 5 to 15 million, with 10.5 million being the current median. Now we're into Series A. Now we're at Series A, pretty much all the emotion is out of the deal. It is a discounted cash flow model. You better have solid traction. There better be comps. Your friends and family, the investors that can participate here, they don't care as much about emotion. You can't influence them as easily. They've got analysts. They're going to do all sorts of things. So the investment range here is typically $3 to $15 million, with just over 8 being the median Series A size as of the end of 2022. And valuations are 15 to 75 million, with 30 million being the median valuation. And then you get into Series B and later, and kind of all bets are off then. So it's definitely a mathematical situation. It's a large business at this point. People are investing between $15 and $100 million, with 30 million being the median Series B. And the valuations can be all over the place. I put up 75 to 500 million because that's what shows on Wilson Sonsini's chart. But there's all sorts of things that happen here. with 165 million being the median Series B valuation. I haven't put anything on Series C or going public because it's not super relevant to startup valuations, but it's just to bring home, we go from emotion to math as the stage progresses, which means, to my earlier point, if you act like you're at a seed stage company and you're requesting investment in ranges that are seed stage, you're going to need to have some traction. And if you are actually a pre-seed company by traction and you're trying to raise at valuations or at numbers that are seed stage, you will fail. It will be a very difficult process and you will not enjoy it. So let's talk about the Matilda. Matilda's the perfect child, the perfect student. So we're going to go through like how Matilda would make a cap table over the life cycle of a company. This is the golden child, perfect founder cap table. So it's everybody listening right now, for sure. So in the beginning, you give away some amount of your company, maybe an early employee, a friend, somebody who helps you out with something, and hopefully you don't give away a ton. It may feel like you need to because the valuations are huge. Here you better get pretty far with very few resources. So you should be retaining the majority of the equity in your company as a founding team. It says founder equity, but it could also be founding team. And here we're seeing post-money valuations of $1 million. What does that mean if you can only give away 5% of your company? You better be able to get from this stage to the next stage on little resources. So that's the thing that's super important. And you see your founder equity value is at $950 because you sold 50,000 of it to your mom. In the pre-seed stage, the rounds should typically not give away more than 20% of the company's total cap table, which would take you down to 76% equity. And you can see this sliding scale to where you don't lose control of your company as a founder until a significantly later stage when you have professional management, and it doesn't matter as much that you don't necessarily own 51% of your company. So this matters a lot. You can see down at the end of the line, it's Series B using those average Wilson-Sonsini values and the average percent of companies sold per round. You end up doing pretty well for yourself over the course of building up your startup to be worth $195 million, and you've made $80 million for the founding team, and a lot of investors really successful. So this is what your cap table should look like over the life cycle of your business. There's some wiggle room in here. You could skip a round. You could have more employee equity than you have in other rounds, and some of that all needs to be reserved for, but you need to be very careful at each of these rounds not to break your cap table. Okay, so let's talk about like this resource allocation method. How do we decide like what our company is worth, how much we should raise, and where we're at? First of all, we make sure we're in the right stage, and then we figure out what does it cost us to get to the next stage of our company's life cycle. Because remember, if I'm raising in the wrong bucket of my company's life cycle, I will not be successful. I will not have a valuation that works. And so if I don't make it from pre-seed, what that means, like I don't make it from validating my idea to generating some cash flow, I'm going to be stuck. There will not be additional investment. It will be very difficult if I underplan these earlier rounds. So this really matters because let's say you're building a high-cost manufacturing company. Let's say you're starting a Tesla competitor. You cannot compete with Tesla on an idea and $500,000 of investment. You wouldn't even be able to buy one machine to help you start doing that. So that whole concept means this business is going to take more money to go from one stage to the next, which means the amount of money we need is a lot higher, but also we don't want to break the cap table. So the valuation ends up a lot higher just because we have a floor on our valuation. If we're smart and we're managing our cap table carefully, my business cannot be worth less than $2.5 million if I'm investing $500,000 at the seed stage and I'm not willing to give up more than 20% of it at that stage. And if it's a high-cost operation, then it cannot be worth less than $50 million, or I need to go back to the drawing board and figure something out. And this is where it gets broken. This is where people say, oh, I just need the more money, or I just need this, instead of going back to the drawing board and saying, how can I develop a plan that makes this happen? How am I doing on time? We're okay. 2 more minutes? Okay, great. Okay, so then your investor is going, I talked about how in this method, the Russ Monson method, there's a low range and a high range. The high range is going to be what in return does an investor need? And you're not going to have visibility into this. So they're going to know some required return. I've expressed it here in numbers. They'll express it in some other rate of return or something along those lines. And they'll say, I need to make $100 million on this risky of a business. Therefore, it needs to exit at least this value after I've been diluted from my 20% investment to 11%, which means if I discount it for the risk over the time I think it will take you to build this business, the most I can pay for this business is $3.6 million. You'll never know that number as a startup founder, but it is there, and it's usually going to be higher than your valuation floor. So you want to start there and start to get an understanding of what it could be worth. And you can see in the high cost example, it's the same situation, but in that situation, the venture investor is showing, we think this business is less risky. So if you look through this life cycle, from friends and family to pre-seed, seed, Series A, Series B, to going public, over the course of this is a kind of a RevRoad concept that we do for all of our startups. We need to make sure that we're raising based on where we are in our life cycle stage, and this is how you know. And it's the hardest thing for a founder to do, to make sure you stay in the right place. You want to be there, and you want to know, I'm raising more emotionally now, I'm raising more mathematically later, and I better not try to raise a seed round when I'm in the focus on pain, ICP, solution. I need to be further along and be raising for the right stage. Okay, you done messed up, AA Ron. This is how we see a lot of cap tables come through. So friends and family, I won't try to pronounce anyone's name, by the way. I don't want to hurt anybody's feelings. I would be terrible at it. So we have a friends and family round. Oftentimes, we see 30% of the company already sold. Then in the pre-seed round, some friend comes along who happens to have money and believes in you and says, well, I'm going to give you $200,000 for 40% of your company. And you're desperate, so you say yes, and you break your cap table. And now you don't have control of your company before you've even figured out what it takes to get to your seed round, to get to a Series A round. And you only own 42% of your company. And then as you go along, what happens is investors become less interested in you because your cap table's broken. So even if you're an amazing founder with an amazing idea, an amazing business, if you break your cap table early on, they will not believe that you're going to be a motivated enough founder, and it'll be a signal that you don't know what you're doing. So you can see the value the founder creates is less than half, and that's just mathematically. In almost certainty, you just won't raise subsequent money, and you'll be trapped. So that's what we want to avoid by managing the cap table carefully. So I hope this has been helpful. I want everybody to go take whatever potato they have in their life and progressively turn it into something better. You don't turn your potato from potato into J.R. Simplot family. You go through that life cycle, and you go through, I'm turning my potato into a French fry. I'm turning my French fry into 5 containers of French fries. I'm turning it into a food truck. Then I'm turning it into this. And at each of those stages, it's very important that we're realistic about our valuations. We're honest with ourselves about what stage we are, how much traction we have, and we sell the right amount of our company to get the resources we need to make sure we make it to the next stage so we don't get stuck. And if you do that right, you'll be much more likely to see a high level of success with your startup. So, thank you.